Welcome to this edition of the M&A University presented by PCE Investment Bankers. Today we're looking at how to structure the sale of your business and the factors that will influence your decision to move forward with a stock or asset sale. Understanding the differences in these structures will have an impact on the risk you undertake as well as significant tax consequences. My name is Mike Rosendahl. I'm an investment banker for PCE Investment Bankers, and I am based out of our New York area office. PCE is an investment bank providing M&A and ESOP transaction services to middle market businesses. Let's get started. When you decide to sell your business, you and the buyer will need to agree on a way to structure the sale, either as an asset sale or a stock sale. But because you'll have competing interests, what's good for the buyer may not necessarily work for you. As I mentioned, understanding the differences in how asset and stock sales are structured is key to ensuring you benefit optimally from the transaction. As you might expect, an asset sale is the purchase of individual assets and liabilities, whereas a stock sale is the purchase of the owner's share of a corporation or interest in an LLC or partnership. Among the many considerations when negotiating the structure of the sale are your tax implications and potential liabilities. Stock and asset sales affect these issues in different ways. For this reason, we find that buyers typically prefer asset sales while sellers generally opt for stock sales. If the business in question is a partnership or limited liability company, the transaction will either be an asset sale or a sale of their partnership membership or interests, since none of these entity structures have stock. Even though you are selling your interest in a company instead of stock, the sale is very similar to a stock sale. If the business is incorporated either as a C corporation or as a sub-S corporation, the buyer and seller must decide whether to structure the deal as an asset sale or a stock sale. Let's start by looking at the asset sale in detail. An asset sale involves the purchase of individual assets and liabilities. Asset sales, like most transactions, are generally a cash-free, debt-free transaction. The seller retains his cash and long-term debt obligation and stays in control of the legal entity. The buyer purchases the company's individual assets, such as equipment, fixtures, leasehold improvements, licenses, goodwill, intellectual property, trade secrets, and trade names, and assumes certain agreed-on liabilities. Net working capital is also typically included in a sale. To get a better understanding of the working capital and why it is an important deal point, please be sure to view our M&A University presentation, Negotiating the Letter of Intent. Asset sales are less appealing to the seller for one simple reason: higher taxes. In an asset sale, sellers are subject to potentially higher taxes than in a stock sale. While intangible assets, such as goodwill, are taxed at capital gains rates, other hard assets may be taxed at higher ordinary income tax rates. Currently, federal capital gains rates are around 20%, while state rates vary. Ordinary income tax rates depend on the seller's tax bracket. In addition, if the selling company is a C corporation, the seller faces double taxation. The selling company is first taxed when selling the assets to the buyer, and again when the proceeds transfer outside the corporation. On the bright side, in light of their higher tax costs, sellers may have more leverage in negotiating a higher purchase price. Buyers typically prefer the asset sale structure because under IRS regulations, the buyer will receive a step up in the basis of the selling company's depreciable assets. This means the price paid for the asset is the new tax basis for the property. The buyer can increase its tax deductions for depreciation by allocating a higher value to the assets that depreciate quickly, and amortization by assigning lower values to assets that amortize slowly, like goodwill. The step up will ultimately reduces the tax liability faster and improves the company's cash flow during the early years when cash flow is most important. Not surprisingly, this issue can be contentious due to the benefits and costs associated with the outcome. Another reason buyers prefer asset sales is that they can choose which, if any, liabilities they will assume. Contingent liabilities such as contract disputes, product warranty issues, or employee lawsuits are of particular concern. Buyers can also opt not to purchase certain assets, such as accounts receivable the buyer determines are likely uncollectible. A potential hurdle for buyers in an asset sale relates to the transfer of certain assets, such as intellectual property, contracts, leases, and permits, which can raise questions about assignability, legal ownership, and third-party consent. The time it takes to obtain consents and refile permit applications often delays the transaction process. Now let's look at the stock deal. In some ways, a stock sale might be less complex than an asset sale, but asset and stock sales both present challenges. In a stock sale, the buyer purchases the seller's share in a corporation or the seller's interest in an LLC or membership in a partnership. In all the cases, securing ownership of the seller's legal entity, as well as all the assets and liabilities. Any assets and liabilities the buyer doesn't want can be distributed or paid off before or at the close of the transaction. In contrast to an asset sale, stock sales usually do not require as many third-party consents be obtained because the title of each asset remains with the corporation. The one exception is a change of control provision. A contract that contains such a provision will require consent of all interested parties before ownership can be transferred. Sellers often prefer stock sales because of the simplicity and the preferential tax treatment they receive. All the proceeds from the sale are taxed at a lower capital gains rate, and corporate level taxes for C corporations are bypassed altogether. Further, sellers may be able to avoid responsibility for future liabilities such as product liability claims, contract claims, and employee lawsuits, although the buyer may insist the seller assume these responsibilities. Buyers typically do not wish to undertake stock purchases since they do not have the ability to step up the basis of their assets and redepreciate certain assets. The basis of the assets at the time of the sale or book value sets the depreciation basis for the new owner. As a result, the lower depreciation expense will lead to higher taxes for the buyer in the future compared with its tax liability following an asset sale. Additionally, buyers may accept more risk by purchasing the company's stock, including all unknown or undisclosed contingent risk. Future lawsuits, environmental concerns, OSHA violations, employee issues, and other liabilities may become the responsibility of the new owner through a stock purchase, unless the parties exclude these unwanted liabilities in the purchase agreement or limit the potential liabilities in the stock purchase agreement through representations and warranties and indemnifications. One benefit of a stock sale to a buyer of 80% or more of a target corporation is provided by Section 338H10 of the Internal Revenue Code. A 338H10 election allows a buyer of stock to treat the transaction as an acquisition of 100% of the assets of the target for tax purposes. Similar to an asset sale, this election may provide significant savings to the buyer. So which structure is right for you? Asset purchases are less risky for the buyer. In an asset purchase, the buyer selects the specific assets it will require and the liabilities the seller will assume. This selection process limits the buyer's risk but causes the seller to pay more taxes. In a stock purchase, a seller's tax cost is lower, but the buyer assumes more risk, both known and unknown, associated with the seller's assets and liabilities. But this risk can be offset with careful structuring. Take time to carefully weigh your options before deciding how to structure your transaction. Partner with a trusted investment bank, attorney, and CPA early in the process to fully understand which will give you the outcome you want. Thanks for joining me today. We welcome your comments and questions, so please feel free to contact me. My information is listed here. And if you like this presentation, please subscribe to our YouTube channel so you'll be notified whenever new content is posted.